Section 3.1 Understanding Dividend Payout Ratio, Factors Affecting Dividend Payout Ratio. 3.1 Company financial performance, profitability, and earnings have a significant impact on a company's dividend payout ratio. A company's ability to generate profits and maintain a healthy earnings level is closely linked to its capacity to sustain dividend payments. Here's an analysis of how profitability and earnings influence the dividend payout ratio. Profitability. Profitability is a fundamental factor that affects a company's ability to pay dividends. Companies with higher profitability levels generally have more resources available to distribute as dividends. When a company generates higher profits, it has a larger pool of earnings from which it can allocate funds for dividend payments. Higher profitability allows companies to comfortably cover their operating expenses, debt obligations, and capital expenditures while still having sufficient earnings left for dividends. A highly profitable company may have a higher dividend payout ratio, indicating a greater distribution of earnings to shareholders as dividends. Earnings stability. The stability of a company's earnings is crucial for sustaining dividend payments over time. Companies with consistent and predictable earnings tend to have higher dividend payout ratios. Stable earnings provide a reliable source of cash flows to support dividend distributions. A company with stable earnings can commit to a higher payout ratio, knowing that it can generate consistent profits to sustain dividend payments, even during economic downturns or challenging business cycles. In contrast, companies with volatile or cyclical earnings patterns may adopt lower payout ratios to mitigate the risk of dividend cuts during periods of earnings fluctuations. Earnings growth. The growth of a company's earnings is an important factor influencing its dividend payout ratio. Companies that experience steady earnings growth over time often increase their dividend payments to share the benefits of growth with shareholders. A company with increasing earnings can support a higher dividend payout ratio as it generates more earnings available for distribution. A rising payout ratio may indicate that a company is progressively sharing a larger proportion of its earnings with shareholders. Retained earnings, which are the earnings not distributed as dividends and reinvested back into the company, impact the dividend payout ratio. A company that retains a significant portion of its earnings for reinvestment purposes will have a lower dividend payout ratio. Companies that prioritize reinvesting earnings to fuel future growth or fund strategic initiatives allocate a smaller portion of earnings as dividends, resulting in a lower payout ratio. Retained earnings contribute to the company's ability to finance capital expenditures, research and development, acquisitions, and other growth initiatives. Financial health. A company's overall financial health and stability also influence the dividend payout ratio. Factors such as debt levels, liquidity, and cash flow generation impact a company's ability to sustain dividend payments. A financially healthy company with low debt levels and strong cash flow can support a higher dividend payout ratio, as it has the capacity to meet its financial obligations and maintain a consistent dividend policy. Companies with financial challenges, high debt burdens, or liquidity constraints may have lower payout ratios as they prioritize debt reduction, capital restructuring, or improving their financial position. It's important to note that while profitability and earnings are crucial factors in assessing dividend sustainability, other considerations such as cash flow, industry dynamics, growth prospects, and management decisions also influence the dividend payout ratio. Investors should evaluate a company's financial health, earnings stability, growth potential, and cash flow generation in conjunction with the dividend payout ratio to gain a comprehensive understanding of its dividend sustainability. The relationship between dividend payout ratio and earnings growth is an important consideration for investors and can provide insights into a company's dividend policy and future prospects. Here's an analysis of the relationship between these two factors. Dividend payout ratio. The dividend payout ratio represents the proportion of a company's earnings that is distributed to shareholders as dividends. It is calculated by dividing dividends paid by net income or earnings. A higher dividend payout ratio indicates that a larger portion of earnings is being allocated to dividends, while a lower ratio suggests that a smaller proportion of earnings is being distributed. Earnings growth. Earnings growth refers to the rate at which a company's earnings increase over time. It reflects the company's ability to generate higher profits from its operations and can be an indicator of business performance and expansion. Impact of earnings growth on dividend payout ratio. the relationship between dividend payout ratio and earnings growth can vary depending on the company's dividend policy, growth strategy, and industry dynamics. Here are a few scenarios to consider: stable earnings growth and consistent payout ratio. In some cases, a company may have a consistent dividend payout ratio despite earnings growth. This means that as earnings increase, the company maintains the same proportion of earnings allocated to dividends. This can occur when the company aims to provide a steady and predictable income stream to shareholders while retaining a portion of earnings for reinvestment and future growth. Increasing dividend payout ratio with earnings growth. A company experiencing significant earnings growth may choose to increase its dividend payout ratio over time. As earnings rise, the company may allocate a larger proportion of earnings to dividends to reward shareholders and share the benefits of growth. This can be a positive sign for investors, indicating that the company's profitability is improving and that it is committed to returning value to shareholders. Decreasing dividend payout ratio with earnings growth. In certain situations, a company may experience rapid earnings growth, but its dividend payout ratio decreases. This can happen when the company decides to retain a larger portion of earnings for reinvestment to fund expansion, acquisitions, research and development, or other growth initiatives. The company may prioritize using earnings internally to drive future growth rather than distributing them as dividends. Balancing dividends and growth. Companies need to strike a balance between returning value to shareholders through dividends and reinvesting earnings for future growth. The dividend payout ratio reflects this balance. Companies that are in a growth phase or operate in industries with significant opportunities for expansion may choose to retain a higher portion of earnings to fund growth initiatives. Conversely, companies in more mature industries with stable earnings may have higher payout ratios. It's important to note that the relationship between dividend payout ratio and earnings growth can vary across industries and companies with different growth strategies and investor preferences. Investors should consider the company's specific circumstances, financial health, cash flow generation, industry dynamics, and management's capital allocation decisions when assessing the relationship between dividend payout ratio and earnings growth.